You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Well, we've had a very fun week in the markets, to say the least. Volatility still seems to be the theme. We had a little bit of a bounce back today, and I should let you know that we are taping Options Playbook Radio on the 15th of May. The market has closed. The S&P 500 index was up 17 points on the day, closed around 2,850, right in that range. And we had a little bit of a bounce back in the FANG stocks today. So that prompted a trade that I've never talked about on Options Playbook Radio, because just thinking we have some volatility in the marketplace. What is a good way to try to take some of that volatility on a stock like, we're going to look at Apple today, which has had a lot of, a lot of people own Apple, but it's been beaten up a little bit. It's been beaten up. The high for the year is around 230. The high most recently was around 215. And Apple today bounced back a little bit. It's trading at $190.92. Up $2.26. Once again, I'm going to emphasize the markets are closed at this moment, but that's where it traded today. So a little bit of a bounce back. So we still got some volatility in the marketplace, and particularly in all the FANG stocks because of the moves, the dramatic moves that they've had. So on the upside, a lot of people might think, well, this might be a time to do a covered call. The stock has bounced back. Let's see if we can get some premium to try to help out with some of the losses that we've sold. Now, I'm going to focus on a 30-day covered call. In Apple, there's enough premium you could probably do a little bit of a shorter day, but it's going to go hand in hand with the strategy that we're going to talk about. But I'm going to talk about this strategy relative to doing a covered call in Apple. So if I just look at a covered call, we're going to go out 30 days in time. We're going to look where could Apple get back to if this really was a breakout back up to the upside on Apple. Apple at 190.92. I'm looking at selling the 30-day $207.50 strike call. So the expiration date is June 14th, and the strike is 207.50, 207.5. I don't know how many different ways I can say it, but that's the strike that we're looking at. The bid on that option contract is 66 cents. So now that gives you a lot of upside on Apple. Obviously, that's, let's call Apple 191 because it closed very close to that. Minus 207.50, we're looking at 16.5 points of upside, and we're still getting a decent amount of premium for that, even though we're going out 30 days in time, and to be able to pull in 66 cents. But with all that said, some people will shy away. They're like, well, what's 66 cents on Apple? It's a $190 stock. On a percentage basis, that's not that great. So I don't know if I want to risk having my shares called away. Well, if that's your opinion, I like to do a strategy where I like to try to take advantage of some of the pumped up vol and some of the premium that's out there. But I do get a little bit nervous sometimes on doing covered calls because of everything that we mentioned. So are you going to roll it if it gets up to that strike? Would you just close out, take the loss on the call? And you'd obviously have a very big gain on the stock in that instance. The gain on the stock would be, if it went all the way up to that strike, would be much, much more than the loss on the option contract relative. But a way that I like to approach it, and some people have called this covered call on steroids, is I like to look at front spreads. When we don't talk about front spreads that often on Options Playbook Radio, because if you just look at a front spread overall, that means that you are going to be buying a call and then selling two calls that are further out of the money, and you're hoping to pay for that call by the sale of the two calls. Well, in that instance, if you do not own stock and you just look at a front spread profit and loss graph, you have unlimited risk if the marketplace continues on up. Where a front spread gets interesting to me is when you tie it in with stock ownership. So in our instance, that's going to be our paper trade for this week. And as always on Options Playbook Radio, we do not intend this to be a recommendation, but it's an interesting alternative to doing a straight out covered call on Apple. And that's what Options Playbook Radio is all about. We just want to look at, well, where is a scenario where this strategy might fit? Because we have over 40 strategies in the Options Playbook for bulls, bears, rookies, all-stars. We cover the whole gamut. So we try to look for scenarios where we can maybe talk about a specific strategy. And I think that this is good timing considering what has happened with the FANG stocks. And there's probably a lot of people out there that own Apple. I'm just guessing. Okay, so what's the front spread I'm going to look at? We're going to go out to the June 14th date. And our whole goal is to try to bring in a net credit to the account. We talked about the June 14, 207.50 strike call trading for 66 cents on the bid. So what we're going to do is, guess what? We're going to sell two of those. But we're pretending we have 100 shares of stock. So if we sold two of those calls and we have 100 shares of stock, well, that's going to leave us naked on one of those calls. So to help offset that, we're going to buy one of the 205 strike calls. Same expiration date, but 2.5 points closer to where the current stock price is at. So obviously that option contract is going to be worth a little bit more than the one that we sold. That contract is bidding 95 cents, asking 1 cent. So we're just laying around here with our Apple stock. We're thinking about a covered call, and then we think of the front spread. So the concept here is that we own 100 shares of Apple. Apple's gotten beaten up. We want to take some of the premium out of the marketplace, and we just don't want to have that potential of Apple blasting through our strike price and the stock getting taken away. So if we put on the front spread, that means we own the 100 shares in our account. We go out, we enter the order to buy one June 14, 205 strike call and sell two of the June 14, 207.50 strike calls. And we try to get it done for a net credit of 37 cents to the account, which is the midpoint. So not quite in half. We're getting half the credit would be 33 cents if we had just sold the call outright. We're still getting an okay credit, 37 cents if we can fill at that midpoint. But we've just added an interesting dynamic. If Apple starts going on up, we are long a spread from 250 to 207.50, 2.5 point spread. That means that if Apple went up to 207.50 tomorrow, our 205 strike call would be 2.5 points in the money. And that would help offset any losses, first of all, that we might have had from doing the covered call. And on top of it, as that underlying is going up, that allows us an opportunity to just close out everything and just get out of the call at even, because our 205 strike call is going to have a higher delta than our 207.50 strike call. So market just stays flat or it slowly starts trickling up, we make our 37 cents. That helps out. There's no harm in doing that. And you can do these for, every share of Apple that you have. You got 1,000 shares of Apple. You can do this 10 times. It would be a 1/20 front spread. You'd be buying one contract, and for every one that you buy, you're going to be selling two. And the only reason why we can do this is because we own the shares of stock. That second option contract, if you will, in the ratio that we're selling is covered by the stock. So always an interesting alternative, especially in stocks that have some increased volatility right now. It gives you a few more options than just selling that covered call outright. So let's do a quick recap. We're thinking about doing a covered call on Apple, and as opposed to doing the covered call, we're going to actually do a covered call on steroids, otherwise known as a front spread with calls. And we're going to do that based on the fact that we own at least 100 shares of Apple. If we own 100 shares of Apple in our account, we're going to go on out. We're going to go out 30 days, look at the June 14th expiration. We're going to buy the 205 call, one of them. Then we're going to go and look at the same expiration and selling two of the 207.50 calls, and we're going to do that trade for a net credit of 37 cents to the account. That's simple. Now, a couple of good things about this. I might not have gone out 30 days if I just sold the call, but I don't mind doing it in this type of trade because I could even just close this entire trade out for zero. Even though I brought it in for a net credit, if the market starts going on up, I can actually make a profit on this. This could, from 205 to 207.50, I got 2.5 points that I can make on my long spread that I attached to my covered call position. So very interesting way to think about covered call trading. And I think that with the market conditions the way it is, it makes it even more attractive. All right, that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back the same time, same place next week. Till then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions@theoptionsinsider.com.